Imagine this, you finally have $20,000 saved up.
Which is not easy in Canada right now.
And then you open YouTube and every finance channel is screaming at you. Open TFSA, open RRSP, max out this, invest in that.
And you're sitting there like, where do I even start?
Today, we're breaking down the exact order you should prioritize these accounts based on your income and your goals.
No fluff, just the exact strategy that worked for us. I'm Choiti.
And I'm Pratik. Welcome back to 2 Cents Diaries.
Let's get into it. The biggest mistake? Treating all three accounts the same. Spreading a little bit across each one and not maximizing any of them. Or worse, prioritizing the wrong account in your situation and leaving thousands of dollars on the table. The order you choose matters a lot. And it depends on two things: your income level and whether you are planning to buy a home. Let's start with lower income earners. If you are making under $50,000, which includes a lot of newcomers in their first years here, here's the order. Priority 1, FHSA. If you are planning to buy a home, even at lower income, the tax deduction is valuable. And you're building your down payment tax-free. Max out that $8,000 if you can. If not, contribute what you are able to. Priority 2, TFSA. Here's why it beats the RRSP at lower income. In a lower tax bracket, your RRSP refund is small, but with a TFSA, your money grows tax-free forever, and you can access it anytime. Emergency car repair, sudden flight back home, you want that flexibility when you're starting out. Plus, if your income goes up later, you can always shift your money into your RRSP when the deduction is worth more. Priority 3, RRSP. At lower income, RRSP is last. The tax refund just isn't big enough to justify locking your money away. So to recap, FHSA first if you're buying a home, TFSA second for flexibility and growth, RRSP last. Hey, if you have made it this far, you're definitely serious about your money. So why not subscribe and help the channel grow? We drop a new video every 2 weeks, breaking down money, life, and everything in between as newcomers in Canada. No gatekeeping, just real talk from two people figuring it out right alongside you.
Now, if you're making $100K or more, you need to tweak your strategy. If you're a first-time homebuyer, the priority is still the same, FHSA. For first-time homebuyers, that account is just too good to skip for saving up for your down payment. But here's where things change. Priority 2, RRSP. At higher income, you're in a higher tax bracket. That means your RRSP contribution can get you back 30, 40, or even 50% as refund. Contribute $10,000 at a 40% tax bracket, you're getting $4,000 back from the CRA. You see the math here, right? And here's an important piece of advice. Take that refund and invest it directly into your TFSA. Don't just spend it. Now, your tax savings are generating tax-free growth. Do this every year, and it adds up to tens of thousands of dollars over time. Priority 3, TFSA. As a newcomer, your TFSA room will not be that significant. It's still important. At higher income, you want the biggest tax deduction first. Max your FHSA, max your RRSP, and then if you have some money left over, you can put it into your TFSA. And as suggested before, you should put your tax refund into your TFSA as well. Since you're earning well, you should aim to max out all three accounts. Just don't try to mix and match. Follow that order, and eventually you should be able to max out all of them. Couple of special situations to cover quickly. You're not buying a home, you can skip the FHSA entirely. Lower income, go to TFSA and then RRSP. Higher income, go RRSP first and then TFSA. You can always open up an FHSA and contribute later when you decide to buy a home. Another option is to just use FHSA as an extended RRSP. Put your money in, invest that money, and just let it grow. After 15 years of opening the FHSA, your money and all the growth you had will be merged into your RRSP without affecting your RRSP contribution room. Since newcomers don't have prior contribution room before landing in Canada, that extra room can always be helpful. If your yearly income is somewhere in the middle, like say $70,000, you have options. You can split between your TFSA and RRSP, or just lean towards TFSA completely if you value the flexibility. It depends whether you want to have accessible money now or you just want to get a tax refund now. I would suggest you to go with the TFSA. And final critical thing to remember, if your employer offers RRSP matching, always contribute enough to get the full match. That's 100% return on your money. Why don't you take that? That's free money. Even if you are in a lower income bracket and we said RRSP is last, employer matching changes that. Get the match first and then follow the rest of the strategy. Quick reminder, everything we're sharing is for educational purposes only. This is not financial advice. If you need concrete advice on your finances, please talk to a licensed financial advisor.
Finally, here's your simple action plan.
Step 1. Figure out your income category and potential for your future income growth.
Step 2. Decide if you're buying a home. If yes, FHSA is your starting point.
Step 3. Follow the priority order. Don't spread yourself thin. Focus on maxing one account at a time in the right order.
Step 4. When you get your tax refund, don't spend it. Invest it in your TFSA.
That's how you turn your tax savings into lifelong tax-free growth.
We have made detailed videos on TFSA, FHSA, and RRSP. Links in the description. Go watch those next.
Drop a comment and tell us which account you are prioritizing. We read every single comment.
And if you're new here, subscribe. New videos every 2 weeks.
In the meantime, watch this video where we rank the best high-interest savings accounts in Canada in 2026. Thanks for watching.
And we'll see you in the next one.